To assess a commercial property investment, one of the things that you need to look into is the build value. What is the improvement, what is that building, and how much that building worth. In this video, I am going to share with you to know how to calculate, how to evaluate the build value. That is one of the critical factor of your investment. So if you want to know, stick around. Alright, so build value. Now, whenever you are buying a commercial property, assuming it's a tenanted building, it means there is a tenant, the business is already going on, and for sure that the building is certain number of years old, right? Now, my experience says that whenever you look a commercial property, the older building will always have less emotional appeal as compared to the newer building. Like when you see a brand new building, no matter whether it's a residential property or a commercial property, the emotional appeal always kicks in. So newer building, more emotional value, which means people will generally pay a premium for the newer building. Now, if you want to become an investor into commercial sector, what you need to look into is sometimes you make more money in the older building than the newer building. And why is it so? Because just like we all know that it's a brand new car. Let's say if it is like a $50,000 car, within 3 to 5 years time, that $50,000 car becomes $25,000 because the brand new, that emotional appeal is always there, versus the pre-owned 3 to 5 years, it's always be almost the half of that value. Now, if an average car, let's say 10 to 15 years, so that means for the next 10 years, so the first 5 years, it is half, and the next 10 years, it is the other half. Let's assuming that in 15 years you have to just depreciate that whole asset or the whole car, right? Same example, if you do this and do this calculation in the building, commercial property building, if it is built properly, it is going to last for, let's say, 100 years. But my experience is that building depreciates, particularly in terms of that emotional appeal and all, it becomes like kind of a half within 15 to 20 years. So that means the next 80 years, it's the other half. And that is a significant point to understand, that if you can buy a building which is, let's say, the replacement cost right now is, let's say, $2 million, and if you can buy that for $1 million and it has already been gone like 10 or 15 years, that means for sure you are buying a way below that replacement cost. So that means you are buying for a good investment. Just from the building point of view, we haven't gone to the other part. Just I'm talking about the building. So rather than thinking about buying a brand new building, I would always look for those investments where it makes money in terms of that first 10 to 15 years, and the replacement cost of that is become half. So in other words, the same building, same type of building right now, if it costs $2 million, if you are buying this for $1 million, is always going to be a better investment than buying something brand new, similar nature with a $2 million. Now, another part, and this is the part that you need to be aware of, that even though it is new build, sometimes it is not as good quality as the old build. Why is it so? Because earlier days, 20, 30 years ago, the way the build quality was, perhaps in newer building, it might not have that same quality, which is why you need to understand about this build value. So to look into this, you have to assess how good quality of the building. Sometimes I saw people are saying that, okay, earlier the building is like built to last, like you build to last for longer time. Now these days people are building build to sell. So in other words, like you build, outside looks good and all, and people just buy. Once you buy, 5 years, 10 years down the line, there are some issues in the building that is going to cost you money, and that means you are buying from the premium. So my experience always says that if you want to make money in commercial real estate, you need to look into a little bit of older building, but a good quality building. And as long as your replacement value is little less or half of that what you are buying right now, you would always make money from that building itself. Now think another perspective. Let's say in that area, wherever you are buying this building, the population is stable. So it's not going down, it's not going up too much, so it's stable. Which means, and if you are buying with the replacement value of 50%, and it's a 15 years 20 years old building, no one will be able to compete with you to build another brand new and provide you the same rent. That's not possible, right? Because your value is less, and as a result you can compete. Your rent is, let's say, X. Somebody with the 2X build value will have to charge 2X rent, otherwise they will not be able to make money. Because remember, commercial real estate, everybody wants to make money like you, so that you are buying this. So your goal would always be, how I can buy a building which is only 10, 15, 20 years old, but 50% of the below replacement value, so that I can be always in the premium. I can always be in a level where nobody able to come and match it. Nobody able to build another building next somewhere in that vicinity be able to provide the same service that I can give. And this needs a lot of understanding, and this needs a lot of capability about, as an investor, to assess the deal and to be able to go ahead. Because most people, sometimes they just look for the brand new building and pay the premium price, and then 5 years down the line they see that, oh, it's not making as much. So a lot to know and lot to learn about that build cost, about the replacement cost, and what's happening in and around area. If, of course, if there is a huge amount of population growth, and you see that even if you buy a brand new building, the build cost is going higher and higher every single year, then yes, it might make sense for you to buy a brand new, because you know that 5 years down the line or 10 years down the line, your building would be the old, but someone else will bring brand new building, but you will be in the same position as buying a old building now versus the new building. So you need to look into and assess which area, which particular area that you are buying in, and what kind of asset you are buying. A lot depends on the overall deal, but fundamentally what I want you to understand is that older building, good quality older building with a 50% replacement value can give you better income, better return, and a better investment than the brand new building. And if you understand that, then you would be, that's one parameter you would be using it to assess your situation, to assess your investment journey. I hope you find this video is helpful and it gives you a trigger to understand, to think about that, what is the commercial property investment, and more importantly, the building part. If you like this video, consider subscribing our channel, turn the notification bell on, so you get to see more videos like this, and it also help us to reach out to more people like you. Thank you so much, and I'll see you next time. Bye bye.